Globalization, it's a word that gets thrown around a lot, but what does it actually mean? Simply put, it's the process of the world becoming more interconnected, like really interconnected. This interconnectedness has been happening for centuries, driven by trade, technology, and the movement of people. From the ancient Silk Road that connected Asia with Europe, to the age of exploration that saw ships crossing oceans, the world has always been on a path towards greater connectivity. But in the past few decades, globalization has accelerated at an unprecedented rate. The advent of the internet, the rise of multinational corporations, and the ease of international travel have all contributed to this rapid pace. And nowhere is this more evident than in the world of finance. Think about it. The financial markets are now more interconnected than ever before. You can now buy a cup of coffee in Paris with a credit card issued in New York. This simple act is a testament to the seamless integration of financial systems across borders. You can invest in a company in Tokyo with the click of a button. Online trading platforms have made it possible for individuals to participate in global markets from the comfort of their homes. You can even send money to a friend in Buenos Aires in seconds using a mobile app. This ease of transferring money across borders has opened up new opportunities for businesses and individuals alike. This interconnectedness has revolutionized the way we think about money, markets, and the global economy. The barriers that once separated national economies are now being dismantled, creating a truly global financial system. But this financial revolution didn't happen overnight. It has been a gradual process, shaped by numerous factors over time. It's been a long and winding road, marked by both progress and setbacks. Financial crises, regulatory changes, and technological advancements have all played a role in shaping the current landscape. From the early days of international trade to the rise of multinational corporations, the history of finance is inextricably linked to the forces of globalization. The development of international banking systems, the establishment of stock exchanges, and the creation of global financial institutions have all been milestones in this journey. And as we'll see, this story is far from over. The relationship between finance and globalization continues to evolve, influenced by emerging technologies and shifting geopolitical landscapes. The future of finance is likely to be just as dynamic and transformative as its past. Innovations such as blockchain, cryptocurrencies, and fintech are poised to further revolutionize the financial world. So buckle up, because we're about to embark on a deep dive into the fascinating and complex world of globalization and finance. We'll explore how these forces have shaped our world and what the future might hold for the global financial system. The video is for educational and entertainment purposes only. It is not financial advice. Do your own research and do not invest more than what you can afford to lose. To understand the modern global financial system, we need to rewind the clock to the aftermath of World War II. The world was in a state of disarray, economies were shattered, and there was an urgent need for a new financial order. The year is 1944, and the world is in shambles. Cities lay in ruins, economies are devastated, and nations are grappling with the immense task of rebuilding. Leaders from across the globe gather in a little town called Bretton, New Hampshire, with a monumental task to rebuild the global economy from the ground up. This conference was not just any meeting, it was a gathering of the brightest economic minds and political leaders of the time. What emerged from this historic meeting was the Bretton Woods Agreement, a set of rules that would govern international finance for the next 3 decades. This agreement was revolutionary, setting the stage for a new era of economic cooperation and stability. This agreement established a system of fixed exchange rates, pegging the value of most currencies to the US dollar, which in turn was pegged to gold. This meant that the US dollar became the central pillar of the global financial system. This system aimed to create stability and promote international trade after the chaos of the war. By having fixed exchange rates, countries could trade with each other without the fear of sudden currency devaluations. But like a house of cards, the Bretton Woods system eventually began to crumble. The fixed exchange rate system, while initially successful, started to show cracks as global economic conditions changed. By the early 1970s, under the weight of inflation and growing economic imbalances, the US abandoned the gold standard and the fixed exchange rate system collapsed. This decision was driven by the need to address domestic economic challenges and the unsustainable nature of maintaining gold reserves. This marked a pivotal moment in financial history, ushering in an era of floating exchange rates. The transition was not smooth, and it brought about significant changes in how countries managed their currencies. This shift to floating rates had profound implications for the global financial system. Countries now had the flexibility to adjust their exchange rates based on market conditions, but this also introduced new challenges. It increased volatility in currency markets, but also fostered greater flexibility and integration. The floating exchange rate system allowed for more dynamic responses to economic changes, but it also meant that currency values could fluctuate widely. This paved the way for the rapid globalization of finance that we've witnessed in recent decades. The move to floating rates facilitated the flow of capital across borders, leading to a more interconnected and interdependent global economy. Today, the legacy of Bretton Woods and the shift to floating rates continue to shape the financial landscape, influencing everything from international trade to monetary policy. With the shackles of fixed exchange rates removed, capital was free to flow more easily across borders. This period saw a surge in cross-border investment and the rise of new financial instruments like derivatives and hedge funds. Globalization was no longer just about trading goods. It was about trading money itself. Technological advancements, particularly the internet, further fueled this financial integration. Suddenly, information could travel around the globe at the speed of light. Investors could access real-time data, execute trades, and manage portfolios from anywhere in the world. This created a truly global marketplace for capital. This increased capital mobility brought both benefits and risks. On the one hand, it allowed businesses to access funding from a wider pool of investors, facilitating growth and innovation. Developing countries in particular benefited from increased access to foreign investment. On the other hand, this interconnectedness also increased the risk of financial contagion. A crisis in one corner of the world could quickly spread to others, as evidenced by the Asian financial crisis of 1997 to 98 and the global financial crisis of 2008 to 2009. A digital revolution. The rise of cryptocurrencies in a globalized economy marks a significant shift in how we perceive and handle money. As the world grappled with the fallout from the 2008 financial crisis, traditional financial systems were put under immense scrutiny. Amidst this turmoil, a new player emerged on the scene, Bitcoin, offering an alternative to the conventional financial systems. Created in 2009 by the pseudonymous Satoshi Nakamoto, Bitcoin was designed to be a decentralized digital currency. Bitcoin was the first cryptocurrency, pioneering a new era of digital money. It operates independently of central banks and governments, challenging the traditional financial authorities. Bitcoin and other cryptocurrencies were born out of a desire for a more decentralized and transparent financial system. They leverage blockchain technology, a secure and transparent way to record transactions and track assets, ensuring that every transaction is verifiable and immutable. This technology enabled the creation of a parallel financial system free from the control of traditional financial institutions, offering a new level of financial autonomy. The rise of cryptocurrencies coincided with the increasing digitization of the global economy. E-commerce was booming and digital transactions were becoming the norm. More and more people were comfortable conducting transactions online, paving the way for digital currencies to gain acceptance. This created fertile ground for cryptocurrencies to gain traction, as they offered a new way to conduct transactions without the need for traditional banking systems. While still in its early stages of development, the cryptocurrency market has shown tremendous potential. The market has grown exponentially in recent years, attracting significant investment and interest from around the world. This growth has attracted both passionate advocates who see cryptocurrencies as the future of money, and skeptical critics who question their stability and security. But one thing is certain, cryptocurrencies have disrupted the financial landscape. They have sparked a global debate about the future of money. challenging us to rethink our financial systems in a rapidly globalizing world. As governments and regulatory bodies grapple with how to handle this new form of currency, the impact of cryptocurrencies on the global economy continues to unfold. Innovations in blockchain technology and digital currencies are paving the way for new financial products and services, promising to revolutionize the way we think about money and transactions. As cryptocurrencies move towards mainstream adoption, their potential to transform the global economy becomes increasingly apparent. The future of cryptocurrencies in a globalized economy is still unfolding, but their impact on the world markets is undeniable. They offer the promise of financial inclusion, providing access to financial services for unbanked populations around the world. While there are challenges to overcome, the opportunities presented by cryptocurrencies are vast, and their role in the future financial landscape is likely to be significant. Banking the unbanked cryptocurrencies and the promise of financial inclusion. One of the most compelling aspects of cryptocurrencies is their potential to promote financial inclusion. According to the World Bank, nearly 1.7 billion adults worldwide remain unbanked, lacking access to basic financial services like savings accounts, credit, and insurance. Cryptocurrencies offer a potential solution to this challenge. Because they operate on decentralized networks, they can reach populations that are underserved by traditional financial institutions. All that's needed is an internet connection and a smartphone. This is particularly relevant in developing countries, where access to traditional banking infrastructure is often limited. Cryptocurrencies can empower individuals by providing them with a secure and accessible way to store and transfer value, even if they lack a government-issued ID or live in a remote area. Moreover, cryptocurrencies can facilitate cross-border remittances, allowing migrant workers to send money back home to their families quickly and at a lower cost than traditional money transfer services. This can have a significant impact on the lives of millions of people around the world. To start buying cryptocurrencies, use the links in the description below. Special thanks to Wikipedia for providing a structure of knowledge. Thank you for watching our channel. If you found this video helpful, please like, subscribe, and hit the notification bell for more insightful content. Stay tuned for our next video.